About to go live. And we are official. Another episode of Shut Up and Invest. We appreciate you being here today. We got J Money in the house. What's up, brother?
Hey, what's up, Kevin, man? How you doing today?
Bless, bless.
Hey,
Today we are going to be busting up the confusing terminology and all the questions we're getting on a hot topic, part of being your own bank. And we're
mhm,
talking about mortgage notes.
definitely, man. We get a ton of questions about what's PNI, what's PITI, amortization, land contract, contract for deed. All these questions that we get constantly that we kind of want to go through them, kind of give some clarity to what they mean. So um, let's get into it. Hey, just so you know, I almost missed this today too because I forgot daylight savings time happened, but there's no daylight savings time here. So I used to be an hour ahead of Eastern time. So I'm seeing 1 o'clock, thinking like, oh, it's still 12 p.m. back in Miami, and then I realized, oh crap, they caught up to us. So
We're on the same schedule now.
yeah, we're back to the same. Yep. But up until today, we weren't. So
The whole concept of being your own bank really becomes mastering creative finance. And when you're dealing with creative finance, you're essentially dealing with terms, right? You guys are negotiating terms. And once you finalize those terms, you're putting it into a agreement, and that agreement is usually the mortgage note. That is what we're talking about, not the contract, because obviously that's the agreement to buy, but the actual terms as how you're going to deal with the financing portion of it, the monthly payments, who you're going to pay. That's what's called the mortgage note. Now, there is
definitely.
regular mortgage notes when people buy with Wells Fargo or Bank of America or any of the Quicken Loans and Rocket Mortgage and all the regular lenders. They also prepare the terms, whether it's a 30-year fixed, 4% with a 5% down payment. That's the terms that gets put into the mortgage note as well. So the mortgage note is the financing terms put on paper with the promise of paying it back for X amount of years.
Yeah, and let's go a little deeper in that too, because what you said was good, right? So there's your actual purchase contract that you do between you and your seller that outlines the terms, and then when you close on a property, you have your mortgage and your note. Because I get that question a lot. Also, if you do a contract for deed or land contract, okay, because we do contract for deeds, land contracts, agreement for sales too. Don't get confused in all the different terms. They all mean the same thing, right? There's still a type of owner finance transaction, right? But you don't use a mortgage and note in those situations. You actually use a land contract or an agreement for sale, and that is what is in place for the mortgage and note. That's what's recorded at the end of the closing.
Yeah, why don't you break down what that is for people that haven't seen some of the prior shows and they're confused when you start throwing land contract and agreement for sale and all that good stuff.
Got it. So the difference is, if you're gonna buy a house and Kevin's gonna owner finance me the house, right? And he's gonna give me a mortgage and a note, right? And the note will say, hey, I'm gonna sell you this house for $100,000 at 10% for 30 years. Okay, that is a note that I get between me and Kevin. Kevin's the seller, I'm the buyer, and I also get a deed. So I get a deed at the end of that transaction. Okay, if I'm going to do what's called a land contract, I'm going to have a document called a land contract that outlines the same exact terms that my mortgage and note would say, and that's what I would get to record. But the buyer does not get the deed. Okay, so the only difference is the buyer does not take title. They have a contract for deed or a land contract or agreement for sale. They get the same rights as a homeowner, but they don't take title.
Right. And when you say deed and title, you're basically referring to the document or that says who the owner is.
Correct. Yeah. So if you go buy a car, right, you get the title for a car. Okay, you get a deed of trust. You put into title on the house. So it's the same thing. But if you buy a house, or if I sell Kevin my house on land contract, okay, he gets a land contract. He gets a land contract memorandum that is filed with the Register of Deeds, right? So if you look it up, he has interest in the property, but he does not have ownership or title to the property. He doesn't own the deed yet, right? So what that means is he can still go sell that property. He can go fix the property up. He can do what he wants to do with the property, but the deed won't transfer until he pays off whatever the land contract balance is.
Yeah, I like to think of it always, and we've said it on previous shows. It's like the real estate layaway plan. Like I'm gonna make payments, and then when I'm done with my payments, then you're gonna give me the deed. You're gonna give me the title to the house. But technically, I still own the house. I'm making payments on it. I'm working my way to pay this agreement, this mortgage note off, and then I'll have the final free and clear deed or title to the house. Um, my question becomes, which a lot of people get confused, is how is this any different than a lease option to buy agreement?
Got it. So when you do a lease option to buy, you're still in a lease. Okay, the seller and the buyer are still technically in a lease. Okay, so it's a lease with an option to buy down the road. Okay, so let's say Kevin's going to sell me the house for $100,000. I put a $10,000 option down that says within 12 months I have the option to buy that property. Okay, and usually what happens is at 12 months I exercise my option to go get a mortgage to buy it and pay Kevin off. That's how I see a lease option. Now you can be creative with those too, right? But that's how I consider a lease option. When you're doing a land contract or contract for deed, you are buying the house at close, right? So that same 10,000 down payment, I bought the house from him, right? I just don't have complete ownership. I don't have what's called fee simple ownership. I don't have deed title ownership, but I have all the rights of a homeowner. I'm still protected by foreclosure laws. They might be a little bit different. Whereas a lease option, you don't have any ownership of that house until you actually exercise your option to buy it.
Right. So in a lease option to buy, there is not a mortgage note that exists in that agreement.
There's a lease. Yep. You have a lease and an op. So you have two documents. You have the lease between me and the seller, and then you have your option document that states what the option to buy is, how much you put down for the option, and what the terms are when you do buy it. Right. That's what you have in the lease option.
You mentioned foreclosure, and if I have a mortgage note in a contract for deed agreement or an agreement for sale, and I do not make payments per the agreed terms that are written in the mortgage note, what happens to me as the buyer of that property? And now, let's say I made the first 6 months of payments, I honored the agreement and terms on the mortgage note for the first 6 months, but now I got laid off and I stopped making payments that were agreed on that mortgage note. What happens?
Got it. So if it's a mortgage and note, right? You have in your mortgage and note, you have whatever your state is has their own foreclosure laws. Okay, so we won't get deep into that, but some states have foreclosure laws where I foreclose and then the buyer has a redemption period of, let's say, 6 months to pay back in full and get the house back, right? Or Florida has no redemption period, for example. Um, Michigan has where there's a redemption period for a person who buys a mortgage, which is different from a person who buys a land contract. So, but what happens is you have to do what's called a foreclosure process. Okay, let's say Kevin paid for 6 months. On that seventh month, the payment hasn't come. He's 30 days past due. We can then file a foreclosure process. We can start a foreclosure process. Okay, where we would notify him that he's in default and he has to make back all payments in full by a certain date, or we will proceed with the foreclosure process. So that's the same as the foreclosure process as far as filing for it in whatever your state is. The same if you buy on a mortgage and note, a land contract, or agreement for sale, contract for deed. The differences can come in, and again, it's state specific, whereas what the redemption period is. Okay, if you buy with the mortgage and note in Michigan and you're foreclosed on, you have 6 months to redeem the property. Okay, and then the redemption periods also go up depending on how much equity you have in it. Okay, in Michigan, if you have 50% or more equity in the home, you actually can have 12 months redemption, and that's don't. But it's just like a scale. All right, if it's bought in a land contract, your redemption period is only 3 months. So if I sell a house in a land contract, I can foreclose and get the house back quicker than if I sell it on a mortgage and note.
You can't avoid foreclosure whether
No.
you're doing your typical transaction in the state of Florida, for example, where you buy and there's a transfer of deed right away, or you're doing content, feel free to join us on Facebook if your YouTube is giving you issues. So let me see if you're still here. Jay, you can hear me?
Yeah.
Supposedly, I just got the notification right now that there may be some issues on YouTube right now. So just in case, if you guys our page and you'll see this show live on Facebook, we also obviously post the audios on all the podcast platforms. So, all right, so we're back to kind of unpacking mortgage notes and all the different terms and what happens if you pay, if you don't pay. Now it's saying we're having trouble streaming on Facebook as well. It might be the software program for the podcast is having issues.
You got a notification from StreamYard directly? Okay.
Yeah.
Got it.
While we're on the show. All right. Well, now adjustable rate
Arms.
mortgages, all those can exist on the mortgage note. There is not a cookie cutter way of being able to do creative financing. There is definitely negotiated terms, and these go on the mortgage note. So why don't we break down some of these interest only, balloon payments, and ARM terminology? And it's so helpful to learn these, especially when you're in the creative finance world, because you never know when one of these turns out to be attractive to both parties, both the buyer and the seller, and you can use this to make a deal happen.
Yeah, definitely. Kind of break down interest only, Kevin, because I mean I know you do a lot of that in your private financing. So break down what it means, and also I know something that a lot of people get caught up on is how they calculate, right? So if you do interest only, which you're going to pay it off, say in 5 years, how they calculate what they're going to pay.
Yeah, so interest only is exactly that. You're only going to pay the interest on the loan. So it's normally a traditional mortgage, you're paying principal and interest. So principal is what you actually pay towards the balance of what you owe, and interest is how they make their money. Banks, credit cards, car loans, it all works the same. So at the end of the day, if you decide to go with an interest only loan, we got all the wind coming through you over there doing the Titanic pose, Jay.
So,
So if you choose an interest only option, we can go with, I'm going to mute you until you are going to chime in. All right, better. So if you choose an interest only option, you can make a lower payment because you're not paying the extra that you usually pay that goes towards the principal. Why would you want to do this? It increases your cash flow. So if you're doing property where you're going to hold on to it, let's say for a year or two or a couple of years, because you know that's going to appreciate and this is going to be a value add that while you fix it up in a couple of years you're planning to sell it, that interest only option may be something that works out because you can cash flow while you're holding the property. You don't have to make a full payment of principal and interest. The property still goes up in value, and then you can go ahead and do your thing, which is sell it or refinance it and then go into a principal and interest payment. So a lot of hard money, private money loans start off interest only because while you're fixing it up, you want the most minimum out of pocket uh, monthly obligations as possible. So that's why it's a popular term and a popular way of paying on investment style loans. So that's interest only in a nutshell.
got it. Got it. Okay. So yeah, a lot of times your payment gets lower, right? That way you can cash flow higher, and then you pay it off at the end. And I'm walking to get out of that. I was in a wind tunnel, Kevin. So I'm going
Yeah,
back
no,
to safer ground. And
you're
so, what's an arm? Let's talk about an
you,
arm.
you wanted to come out looking like Beyonce on the podcast YouTube. You wanted your shirt blown in the wind and your hair. I got you. That Michael Jackson effect. Um, so one thing I want to point out with interest only, because you might be asking if you're listening to this, well, then how do I ever pay off this loan if I only pay interest only? So a lot of the times they'll let you do interest only for X amount of years, right? So 10 years. And then let's say if you got a 30-year loan, you'll get interest only for the first 10 years. And then the next 20 years, it'll kick in principal and interest based off of 20 years. So your payment will then adjust. And now it'll be a lot higher to pay off the balance within the next 20 years in that example. Those work very similar to the ARMs, right? Or the adjustable rate mortgage. ARM is just the acronym for adjustable rate mortgage. So the adjustable rate mortgages is essentially where you agree to pay a certain interest rate, a certain payment for X amount of time. So you might say, I'll pay 4% for the first 2 years, and then year 3 through 10, I'll pay 6%. And the person might say, okay, fine. The idea here, usually for these ARM products or these ARM financing terms, is let me get a minimum payment for the first couple years, and I'll try to either sell or refinance into something more steady by the time my rate is going to adjust. So these are popular, especially in the jumbo market, where you get it for 3, 5, or 7 years. There's even 10-year. They'll give you essentially like an entry payment, an entry interest rate for those years, and then it'll adjust to whatever the terms are. And that can be continuing to adjust year after year after that first fixed payment period. So let's say on a 5-year ARM, right? That's what they call them. Your first 5 years, the interest rate will be 5%. That's fixed for the first 5 years. Then after year number 6, it'll start to adjust based off whatever market that they're going to base it off of. So, for example, equity lines of credit is based off the prime rate. So, if you Google prime rate, you'll see what the prime rate is, 3.75. And the bank will say, or the lender, whoever it might be, will say, I'll charge you 2% over prime rate. So, after you have 5% for the first 5 years, on year number 6, if it's based off the prime rate market, and whatever it is in year number 6, it could be higher or lower because that adjusts every time the Fed decides to higher or lower the rate, and plus 2%, which is the profit margin that the banks or the lenders assigning based off that market. So year after year, they can say, well, we'll adjust it year after that. So year number 7, it'll adjust again based off whatever the prime rate is. Year number 8, it'll adjust again for however long the term of the mortgage note or your mortgage is going to be.
Quick question.
Usually, you don't want to get to that point. You're trying to make your magic happen within those first fixed years to not deal with, the adjustable rate portion of the agreement.
Yeah, I had a question on that because we all know, well, most of us know that the ARMS was one of the very popular loan programs back during the financial crash that happened before, right? Because they adjusted up high, people couldn't afford them. Do you ever see where the ARM can benefit someone where the rate goes below?
People that had ARMs, once the market crashed and they lowered the interest rates for the economy to recover, a lot of them ended up not experiencing that adjustable rate, fluctuation every year, and their rates never jumped up higher. So they didn't have to refi. They ended up keeping a low interest rate for all those years. And the risk factor of the rate jumping up, they never experienced that because we kept our interest rates so low to allow the economy to recover. So there was a benefit there, I mean, right now, people that have equity lines of credit as well, the prime rate is staying low while all this is going on in our current market. So they're not experiencing high interest rates on their equity lines of credit as well. So you can't guess that, right? I mean, nobody would have known that all these unforeseen events were to happen, but you do track cycles. So year after year, decade after decade, our financial history will tell us this market goes in cycles, interest rates goes in cycles, which affects the market. So if we start really looking at the data, I don't see us getting past 2022, 2023 before there's something that's going to happen that affects the market, because just history says we're overdue for a cycle. So how much more can we potentially kind of push the adjustments to both the rates and market, and it's coming. So
Yeah,
adjustable
definitely. I
rates.
mean,
Go ahead.
I would not look to do an arm right now, right? Because the only way it could go is up, you know. So my thought was, hey, maybe some people that were in the financial crisis actually got a benefit when the rates started coming down, and their arm benefited them. So it's just good to hear that.
You usually when you're negotiating terms on ARMs or adjustable rate mortgages, you're putting a floor and a ceiling to it, right? So most of the time, the floor, meaning they're not going to let it drop lower than what they initially gave you in the beginning. So that's 9 out of 10 times. If you started off with a 5%, like in our example earlier, they're going to say that's your floor. So
Got
if
it.
the market is low like it is now, and you go into your adjusted rate, years, at the very best case scenario, you're going to stay exactly where you were all these years. And then they'll usually put a ceiling, because you're like, oh, well, wait a minute. I mean, it's hard for me to agree. What if I don't sell, or what if I don't refinance? And then year number 5, it's over, and now you're going to raise all the way to 13, 14%, and then I can't afford it. I can't agree to that. So a lot of the times they'll do like a cap. So it's like year after year, it can't go higher than 2%. So worst case scenario, if you start at a 5, the following year, if it goes into adjustable rate year, it can't be higher than 7%. And then the year after that, it can't be higher than 9%. Again, you don't really want to get into those years. Some people do, because they thought they were going to get their credit in order. They thought they were going to get their income in order by then, and they didn't, because maybe they still have bad habits, or maybe life happened, or they had to shut down a company and start a new one, or whatever the case may be, and they can't sell or refinance because the market and the guidelines don't allow them, and they roll into those adjustable rate years, and the plan doesn't work out for them. But that's really based off of the borrower being educated enough to know, if you're giving me 3, 4, 5 years of fixed rate, whether it's interest only or not, that's my clock. I need to get my ducks in order to be able to make moves. And I need to know that there's a potential issue if the market adjusts and I can't sell this. I need to figure out another exit strategy so that this doesn't, end up costing me more than what I anticipated.
Got it. So we mentioned interest only. We mentioned arms, and of course, fixed rate means if you get a 3.5% rate at the beginning of your loan, it stays that way the whole time. It's fixed, right? So we always try to get fixed rates if we can, or like you said, use interest only as a tool. But those are I mean, are there other types of rate, like rate terms out there for loans? I mean, those are the three I usually see.
Yeah, I mean, it's we got real estate with Bill asking, when should someone do this type of loan? So interest only and adjustable rate mortgages are always
Well,
good
I can
for
tell
you.
you, Kevin, I did an interest only loan with you on the deal that we knew was going to be able to close out within about, I think it was 12 months, right? So I paid interest only to keep my cash flow going until the guy was able to pay us off.
Correct. So that's it. You want to be able to get into those deals because it lowers your holding cost, it lowers your out-of-pocket expenses because you have an exit strategy in mind, whether it's refinancing it into a regular deal, which we have a ton of clients that do that. They buy with a private money deal, they pay a 12% interest only option, and then they fix it up, they get it rented, and then they refi into a 6, 7%, 5%, whatever it is. So it makes sense for them to pay an interest only option. Why pay principal and interest when, especially the first couple of years in any loan, depending on how long the term is, a lot of your first year is more interest than you do pay principal. So I'm not saying you don't get a principal and interest loan if you can afford it and there's still cash flow, but if they give you the interest only option, then you can take it. Obviously, you don't pay any of the loan balance down, so that's the main thing you guys got to keep in mind. That if you borrow 100,000 and you get an interest-only loan for 2 years, let's say, and you make payments for 2 years, you're only paying the interest, meaning you still owe $100,000. Like no ifs, ands, or buts about it. So um, what does it matter if you turn around and sell that property for 180,000, or what does it matter if you fix that property up and and you're able to refinance it, and now you have a much lower payment and you were able to get into that deal. So it's a lot about when you should do it and why. It's a lot about when you're acquiring it and what the numbers look like, and if it makes the most sense to keep your costs low while you make your moves, then it's always a great, time period. Another one is, especially if you're doing more of the traditional financing on an adjustable rate, sometimes it's the only way you can qualify to be able to get the property. So you can't qualify on a 30-year fixed option because the rate is higher, but they're giving you a break on the 7-year option, for example, or the 2-year option. Those were very popular before the 2008 economic, crisis with the mortgage industry. A lot of the times, if your credit wasn't, amazing, you would get what they call the 228. So it's fixed for 2 years, and then it would adjust for the next 28 years. And the idea was get this loan for 2 years at this payment, do what you got to do, and then refi or sell the property. And you don't have to wait until it starts adjusting for the next 28 years. So a lot of people were using that loan program. They if they owned the property, they would refinance, cash some money out of the equity, pay off all their debt, and be into that payment with like, okay, now that I paid off all my debt, my credit is going to be better. And within the next year or two, I can then refinance into a regular 30-year mortgage and I'll be good. So that was a very popular strategy back in the day.
Definitely was. There's a lot of those 228s going around. A lot
Yeah.
of those.
We
Let's
got
get to the. Okay.
we got someone asking, can you do an example of how interest-only loan would work with numbers? Love the content. Thanks. Yes, we can. Let me share my screen and bring up a calculator, and I'll show you. It's very easy to calculate. Can you see my screen there, Jay?
Yeah, I got it. Yep.
Okay, so let's say the same $100,000 example at how many years are you gonna lend me this money, Jay?
I'll do 5 years, interest only.
Okay, so you're gonna do a 5-year interest only loan program, and let's do the same interest rate, 5% that we were talking about before. So I'm gonna multiply it times 5% interest, and that is the total interest I'm going to pay per year. So I take the loan amount, I multiply it times the interest rate, 5%, it gives me $5,000. Then I divide it by the number of months in the year, so I know what my payment is every month for the next year. So divided by 12 months gives me $416.66. Well, they'll round it up to 67 cents in that case. So that would be my interest only payment that I would be making um, in this Now, let me bring out an example to kind of compare so that you guys see what we're talking about. If I was, do you see the mortgage calculator on Google right now? You see it, Jay?
Yep, it's there. Yep.
Okay. So that same 100,000 at 5% at 5 years, did you say? Well, let's do 10 years.
5 years. Yep.
Let's do 10 years. Look at how much my payment would be. 1,061. Trying to pay off 100,000 at 5% interest rate for 10 years. So this basically is a perfect example of why I would go interest only and only pay $416 for the next 5 years versus getting something like this. Even if you got a 30-year loan, that would drop it to $537 because now I have more time to pay that loan back, but I still got to pay $537, where an interest only loan will give me $416. So eventually I'm going to have to pay this 100,000 off, but based on Jay's terms, he's giving me 5 years of this payment while I figure out what I got to do to start eventually paying this money off.
Exactly. Yeah. It kind of gives you a buffer, right? It gives you some time to either get your credit back right, or if you're flipping a house, right? I got 5 years to, get this rehab done, flip it, and get out of it. So yeah, you want it to be more of a short-term type of loan than a long. It's not a long-term solution.
Right. We got Joe asking us, who do you get to write up the contracts, the mortgage notes?
So listen, if you're closing right on a property, usually the title company will do. That's who does my land contracts agreement for sales, or my title company, right? If it's a mortgage or a note, I know that we use the title companies to do it, right? I mean, Kevin, do you have someone in-house who does it? I know when I've got a loan through you, it's come either from in-house or from my title company drafts up the documents, or an attorney,
Yeah, basically any real estate attorney has a mortgage note template that they'll adjust based off the terms and conditions that you're giving them, whether it's interest only, whether you're doing an ARM, you're doing 30 years, 10 years, whatever the terms are, it'll go on the mortgage note and they'll write up. So any real estate attorney with the title company that's going to record, because this gets recorded in public records so that we know exactly what the agreement is, they're the ones that will prepare the document. Now,
and remember, this is done at closing, right? So the purchase, because I think people get confused. They think you have to give a mortgage and a note or a land contract at the offer, right? No, you're not. You're getting the offer accepted with your whatever you contract you use, your wholesale contract, or I have a different contract for for owner financing transactions. That has the terms that you agree to at closing. Your title company, your attorney, draft those documents.
correct. So in your realtors can be preparing your contracts in the beginning when you're getting into agreements. You yourself can prepare your contracts if you have a contract already prepped and filled out between you and the owner. You preparing your own mortgage note, I mean, technically, I guess you could and go and get it recorded. I don't write my own mortgage notes. I don't prepare my own mortgage notes. I literally pay my attorney to write our mortgage notes to make sure that everything there is going to be able to hold up in court. God forbid the person doesn't pay me back.
Yeah, and you get a template, right? So like your attorney has a template that he went over with you that you're cool with, and then it's plug and play with the terms and the numbers. You give that template to your title company, they plug and play. So you're not redrafting the contract. Stop.
Right. Then the other term that we mentioned was balloon payments. So we
So
talked
maybe we
about, go ahead.
maybe we say amortization schedule first, and then tell them what a balloon payment is in regards to that. That kind of breaks it
Right.
down a little bit better.
We started off with the things that are like interest rate specific, right? Interest only or an adjustable rate. Now we're talking about the actual term as far as the amortization schedule. How long are you going to pay me back? Are you going to pay me back in a year? Are you going to pay me back in 5 years, 10 years, 30 years? There's no rule. It just depends. How long are you going to give somebody time to pay back that money? So you could do a 40-year, you could do a 50-year agreement if the person agrees on it. Cool. It's just logic is, as the longer it takes me to pay somebody back, the the less I gotta pay, right? Because if I gotta pay
Mhm.
$100,000 and but I give you 4 days to pay me back, and if you're gonna make a payment every day, you're gonna have to make at least $25,000 a day payment. But if I
Yeah,
give you 10 years to pay me back and say just pay me monthly, obviously you don't have to pay me $25,000 a day. So that extreme example just shows that the longer the term, the minimum payment, basically
payment
the
drops
option
down.
becomes.
Yeah,
So the amortization is how long are you going to pay me, and how much is it going to go towards principal, and how much is going to go towards the interest. So you can, again, based off the terms, if you're doing interest only for the first 5 years, and then you're going to pay me back the full balance the next 15 years, that's a 20-year term with the first 5 years as interest only, and the next 15 years fully amortized. So you're going to
mhm.
fully pay it back. So we're
Catch
going
up.
to base that payment off a 15-year payback plan. So you could pay me back that $100,000 in that example. So sometimes, especially when you're doing creative financing with older individuals, they don't want a long term payment plan because they're like, I'm 70 years old. I'm not going to be here in 30 years, most likely. I've heard,
I
I
got
mean,
a
how many
guy.
times have you heard that thing?
I got a guy right now, one of our private lenders, who's like, his term is 13 years because he turns 100 in 13 years. So to him, he'll live to 100. So he'll do a loan with you, but you got 13 years to pay it back.
Nathan, shout out, loves those stuff. We love you guys too, man. Appreciate you listening. So, depending on the negotiation, the person might want their payment fast. Let's say the person says 13 years, and you're like, man, if I borrow 100,000 and I gotta pay you back in 13 years, that payment is high for me. I'm not gonna be able to cash flow. I'm not gonna be able to make this deal work because I know I can rent this for $1,000. So I need that payment to be around 800, 700, 600 to make this deal work. Plus, once I fix it up, it'll be worth more money, like all the things that are in our head. But at 13 years, the payment might be more than what you can rent it for. So you bring to the table a potential balloon payment. So you say, listen, what if I just pay you the 800 bucks a month or the 700 bucks a month? You're cool with that for the next 5 years or for the next 13 years.
Yeah.
Then, whatever the balance is, I will pay you the full amount in 13 years or in 5 years or in 2 years. There's no rule of when you put the balloon, right? So, the reason why they call it the balloon payment is because eventually the balloon pops, right? It's done. It's time to pay the piper, and you got to pay it all up front. So, you
Definitely.
you set cheaper terms and you make a promise that you're going to figure out how to get their payment within the end of the balloon payment, whatever it is, one big pop of the money, and the agreement is over.
Yeah, no, that's so key because what you're doing is when you're talking to a seller, right? You're asking that seller what do they want to make per month. They're more interested in what they want to make per month, right? So they might say, "Hey, I only want 500 bucks per month, but I want to be done with this loan in 5 years." Okay, that might not fit your cash flow opportunity. So you might have to say, "Okay, what I'll do is I'll amortize this loan over 10 years, right? That allows me to pay you 500 bucks per month over 10 years, but I'll put a balloon payment at the end of five. So whatever I owe you at the end of the fifth year, I have to bring that check to you and pay it in full." That's how you can use the amortization schedule and the balloon payment to get the terms that make sense for you.
Right. That's a great strategy, guys. When you know you have a way to pay that money back, maybe you're a wholesaler and you found a great deal that you could do this type of terms with, and you're like, you know what? If I get a balloon payment in 3 years, I know I could wholesale a couple properties and pay this off. So let me
Mhm.
just get in it for the most minimum amount possible, make the payments, rent it, pays for itself, and then, or live in it myself too. You can negotiate this balloon payment terms for even a property you want to stay in there. And then you do what you got to do to come up with the cash. So if you're flipping properties, if you're wholesaling, if your business gives you the amount of money, or you plan to refinance or sell before that balloon pops, then you're good. As long as the person gets their money, basically the balloon payment is the very last day you have to pay me back that money. You could refi the loan, or you could sell the property before, and you're not going to, it doesn't matter. They're not going to say no to getting the money back.
No, they definitely won't. And I mean, I will say we try to stay away from balloons. You know, if you're the buyer, the investor, you don't want the balloon, right? But I mean, there are deals where the seller just wants his money this quickly, and it's still a good deal for me. And we'll take the risk because we know that okay, we have it sitting here in our war chest, ready to go, or we know okay, we're going to buy this, sell it on land contract. They're going to pay us off in 2 years, right? So you know, we try to stay away from balloons. If you take them on, make sure you have a plan to pay that balloon off. Don't just kind of, you know, wing it by the air. And then 5 years come from now, you get a balloon, you don't know what you're doing.
Right. So now that you guys kind of have like, you're familiar with the different terms and a couple different strategies, now let's step back and kind of look at it from a strategic standpoint. If you have an interest only loan, you don't have to pay that full interest per year if you end up selling the property or you end up refinancing. You're only paying the agreed term for as long as that term exists. The minute you have the money to pay it off, you don't have to wait till the balloon payment. You don't have to wait and pay off the full year's worth of interest, even though you flipped the property in 4 months. Then technically you only, in that earlier example at $416, you would only have to pay that for 4 months instead of the full $5,000 for the full year of interest. So that's the benefit of some of these programs and some of these agreements, that you're just doing it to lock it down, to make sure you can get the financing in place, give you time to do what you got to do. But if you can come up with the exit strategy that gives you better numbers or a better return on investment prior to the final terms, then do it 100% and get out of, the original agreement, and it's going to cost you less money 9 out of 10 times.
Yeah, definitely. I mean, even when we sell homes on, you know, land contract, right? And I sell it to someone and we'll do a 30-year term at 10% interest, right? They're going to pay us a lot of interest, you know, and I would love for them to pay me for 30 years at 10% interest. I definitely would, you know, but also I'm advising them, look, you know, pay it to us for 2 years, refinance it out, get a lower interest rate, right? Or a lot of people will buy it from us knowing that they're gonna, you know, they're gonna buy the house and pay the mortgage down sooner and pay it off early, right? So you can always pay off the interest early, and then you save on your total investment to the property as an investor.
Right. We got a question. If you don't want a balloon, what are the strategies you want to use?
Okay, so let's say there's a seller, right, who's adamant about being paid off in 5 years, and it just does not work, right? The numbers don't work, but they won't budge off the 5 years, right? They're not budging. Maybe increase your down payment, right, to try to get them to extend to 5 years. Or, right, you say, okay, I'll pay it in 5 years, but you have to lower your interest rate. Okay, that's when you start messing with the terms, right? So if you need to be paid off in 5 years, I don't want a balloon. How can I get that monthly payment to make sense where I can cash flow? Start lowering the interest rate. Okay, you want 5 years, that payment doesn't make sense for me, and tell them that way. Hey, I can get $900 a month for rent. If my payments on a 5-year balloon, right? I don't do balloons. If I have to pay off for 5 years, I'm paying you $850 per month. That doesn't make sense for me, right? And then say, but if we do the rate, you know, maybe they offered you 5%, you go down to 2.5%. Now my payments, you know, $500 a month, I can do it. So, you know, if the 5 year to that seller is their biggest point, that means they might move on different points and move those levers up and down.
Yeah, really what you're trying to do when you're in this creative financing world and you're negotiating terms that are going to go on this mortgage note, you're trying to figure out, what do they really want? It's like, look, I want this per month, and then by this time, I want all my money back. Once you know what they're comfortable getting per month and when do they technically want to get completely paid off, now you can work. Now it's, hey, does that make sense for me? and how can I create a term that fits what they want to make this deal happen. Those that number works for me if we can do this at a 20-year mortgage, and then I'll do a balloon payment in 5. Okay, you don't want to do balloon? Okay, let's do interest only, and I'll make sure that I can get you your money back in the next 5 years, and give me interest only for the first year. And then next year, I'll start making principal and interest for 4 years, because in a year, you're fixing this up and you're refinancing or you're selling it, and that interest only payment works for you. So, all that is where you're basically trying to um, negotiate and put on the mortgage note.
Yeah, I got an example right now that we just locked up yesterday, a 4 unit in Michigan, where the seller he wants 260, and he wants to be paid off in 15 years. And he was telling me, hey, look, 260, 30,000 down, and pay me off in 15 years at 9% interest rate, right? And he picked the 9% interest because he said, hey, that's what hard money goes for right now, 9%. And those numbers just didn't make sense for me when I went back and did the calculation. So I had to find out, okay, what can we change? So what we changed was the 260 he's not moving off of. He wants his 260 and he wants 15 years. But I was able to take that 9% down to 6.25% because he was less concerned about his monthly payment than he was his final number and his 15 years.
Right. Yeah, perfect example. Um, so we've covered terms, we've covered who writes up the mortgage note, we've covered strategies that go into deciding which terms, interest only, adjustable rate mortgages, balloon payments, regular traditional financing, 10, 20, 15, 30 years. Um, I think we've covered a lot at this point.
I think we
Anything that
have.
I know, you can sell mortgage notes, and we've talked about it in plenty of shows. So if you're the seller and you're holding this mortgage note, you can find somebody to buy this off of you. And then that is a whole different game, but you can sell the mortgage note and they'll pay you the cash based off what you're deciding to sell it for. And I mean, Jay, this is one of your favorite strategies.
It is, because remember, when you create that note, you created it's a paper asset, right? It's a security. It's a paper asset. It can be traded. Okay, I don't own the house. I own the paper that is the note, and then I can go sell that note to Kevin. So if I'm very good at creating terms and originating terms of my note, right, and I'm buying the house for a low price and I'm selling it on the seller financing terms, creating a good note, I can then go sell that note to the secondary market. There are buyers who just want to buy paper. They don't want to own the house ever. They just want to own mortgage notes, right? So I can sell Kevin. Let's say I have a note balance where the balance is $85,000 at 10% over 15 years, and then the payment's what it is, right? I can then go sell that $85,000 balance, right? Notes, usually for 80 to 85% of note balance, if the terms are right. So, I mean, there's some very good money in that. I can also then sell parts of my note. I can sell Kevin, right, 5 years of a 30-year note. Hey, you get the first 5 years, Kevin. You pay me for the first 5 years. When that 5 years is up, I start recouping my payments again, right? So there's a way you can get some quick cash by saying, I don't want to sell my whole note, but I need 15 grand to buy this house. Maybe I'll sell Kevin 5 years of my note. And that's done all the time too. It's called a partial. You buy a partial of the note.
Guys, mortgage notes is just basically agreeing to some numbers, putting it on paper, and making sure it's recorded somewhere so that it can be enforced. That is really as simple as it gets, and there is no rules as far as does it need to be a certain term to be able to go on there. So I hope that kind of clarifies and opens up the mind. That is one of the key components in creative financing, in real estate investing, and just buying a home in general. This is involved in every real estate transaction. So the only time you never have a mortgage note is when you buy a property cash and it's free and clear. There is no money owed to anybody. And that is the only time we eliminate a mortgage note.
Yep. And even these cash offers that you see are cash offers, most of the time there's a private note behind the cash, right? So there are notes even behind a lot of the cash offers that you think are fully cash. I mean, notes probably make up 90% of every transaction there is. So learn how to understand the terms. Learn how to originate them. When you can originate your own notes as far as like creating them yourself, on owner financing terms, you can bring in some really good money with what you can do with that note on the back end. Hey,
Yeah.
Kevin, appreciate it.
As always.
Shut up and invest.